Good morning, everyone. We're going to get started. Give everyone a chance to get to their seats. So, we've been asked to speak about an objective evaluation of private equity options for urology groups. As you all know, there's been a lot of activity. Your offices have probably gotten phone calls from private equity-backed companies, investment bankers, and the like. So I'm just going to tell you about 30 seconds about who is up here purporting to give you an objective evaluation of private equity. So I'm Gary Herschman. I'm a healthcare lawyer. I've been practicing for 29 years in healthcare transactions, representing physician groups and many other providers in the healthcare field. I'm with a national firm, Epstein, Becker & Green. We have 130 healthcare lawyers in 16 offices across the country. And to my right, I didn't even advance the slides. So that's Epstein, Becker & Green. And to my right is Hector Torres with ECG Management Consultants. And Hector is a financial advisor who for the last 17 years has been advising physician groups and other healthcare providers on their strategic options. So also from an objectivity standpoint, I think it's important for you all to know that more than half of our clients that bring us in to talk about this decide not to do anything at all, and that's fine. So we're going to move on and talk about private equity and other strategic options.
Thanks, Gary. Good morning, everyone. Pleasure to be here. Obviously, the market for healthcare services in general, and certainly for physician groups across the United States, is incredibly robust. I remember 10 or 12 years ago trying to call on private equity firms, engage their interest on potential physician group partnerships and affiliations that we were representing and bringing to market. And they sort of would ask, why do you keep calling us? And now it's sort of the inverse, where the private equity firms are calling us and asking for what opportunities we're bringing to market. So in a lot of ways, it's come around full circle. But certainly, as you can see, from a volume perspective alone, the growth has been explosive and parabolic in nature. We're projecting almost 200 transactions to be announced by the end of fiscal year 2018, and that continues a double-digit percentage year-over-year trend. Now, volume and value are two very distinct considerations, and certainly we're seeing robust and sustained upward mobility in both. Here is a very short-form perspective on that valuation element, whereas as early as 5-6 years ago, the median valuation multiples on an EBITDA basis were somewhere in the 6 to 8 times EBITDA range. Today, the medians are actually double-digit, hovering around 10.5 times. So certainly a lot of volume, a lot of deals being announced and done, and the valuations, the pricing of those deals is literally 2 standard deviations to the mean when you think about it on a retrospective basis. Now, when we think about private equity and alternative asset managers, they come in all shapes, sizes, and forms. It's a very rich tapestry of organization types, and really they delineate their investment thesis and their strategy across key criteria. And here is literally just a quick microcosm example of some of that investment criteria. They'll certainly focus by virtue of industry and/or sector. They'll look at sizes of opportunities to invest in, certainly geography and structure. Some of them like to take minority equity positions. Some exclusively invest in majority or control equity positions. And certainly there is, again, that rich spectrum of everything in between. So what are they trying to achieve by virtue of this partnership with physician groups and urology practices specifically? Well, they're not in the business of holding and investing in perpetuity. They have typically a 3 to 5 year investment horizon, and they're hoping to realize a sizable exit by virtue of the growth of the platform and the growth in the value of the platform upon exit. Now, there's 2 ways to grow an organization. There's organic growth, where you're really streamlining operations, pursuing efficiencies and economies of scale, and improving your operational footprint. And then there's growth via acquisition. And really, given the 3 to 5 year time horizon, it's much easier to grow via acquisition than it is to strategically, organically grow your organization in a material and sizable way. So really what they'll do is they'll identify a very strong platform, what they would call a fortress investment, and utilize that as the catalyst to continue to do what they call bolt-on acquisitions, grow the size of the pie, and in 3 to 4 years eventually sell it to what is typically actually now would be a larger private equity firm that would be able to sort of pursue the same strategy at a much bigger scale. Where we are for urology is actually at the very beginning of the life cycle from an investment thesis perspective. Many years ago, dentistry and pain management, and certainly as of 2015, even today, dermatology has been explosive and continues to be. We're seeing ophthalmology as a sector of focus follow suit, and certainly OBGYN, orthopedics, and urology represent the next evolution and wave of the investment thesis and the focus from the financial sponsor community. I won't belabor the key macroeconomic trends, but obviously I'll state the obvious that you're in a very high demand and a growth clinical specialty. All of these macroeconomic trends help support the investment thesis, and that ultimately reflects in the premium valuation and pricing that we're seeing in the market for urology-specific transactions. Again, a little bit more building on that investment thesis. There's a supply and demand imbalance. There aren't enough urologists to serve all of the clinical needs of patients over the next 20 to 30 years. It's a very fragmented market, meaning the vast majority of the market share is not held by 1, 2, or 3 macro national platforms. It's really diluted from a market share perspective, and that makes it very ripe for this buy, build through acquisition strategy that private equity pursues. Here are some examples of some of the early urology PE platforms and their financial sponsors. Audax Group, Altaris, and J.W. Childs have all formed platform investments, and here are some examples of target companies that they've continued to pursue in order to, again, build a much bigger organization and create value via that larger integrated organization.
And based on market intelligence, and I'm sure you're all aware of this because you talk to each other at conferences like this, we understand that there's going to be probably 2 additional private equity companies with platform investments in the next 30 to 60 days. So we see that expect there to be a lot of activity. We're talking to a lot of groups, but we expect there to be a lot of activity next year when these 1 or 2 new platforms close and go live in the next 30 to 60 days.
And if I could just expand on that, there's sort of a little bit of a wait and see perspective from the financial sponsor community. They really want to understand that the proof of concept on the exit realization of some of these larger platforms have been successful. Obviously, we're right at the cusp of that, and we envision that next year there will be a lot more what we call Me Too transactions, where financial sponsors are feeling that that investment thesis in the sector has been validated, and now it warrants continued investment and optimization within it.
So just to be clear, when Hector says financial sponsors, he means private equity companies. Correct. They're kind of synonymous, but we'll talk more about that in a minute.
So from a transactional considerations, we love to work with our clients and really dig into what we call their goals and objectives. It's about beginning with the end in mind. And that's why, to Gary's point, more than 50% of our clients ultimately elect to do nothing because they feel that their goals and objectives as an organization and as a practice can be realized and attained on an independent basis. But where we are in the market for healthcare services and physician practices generally, and urology practices specifically, is there is a rich spectrum of optionality. And when you pursue a process, we always encourage to consider the full spectrum and continuum of potential suitor organizations. Obviously, private equity is one. But when you look at organizations like Optum, And they're really vertically integrated payers and strategic organizations, as well as hospitals and health systems. Hospitals and health systems, from a valuation and economic consideration, aren't going to be able to pay premiums for these acquisitions, but they're constrained by other regulatory considerations. Typically, the highest dollar is paid by private equity, but there are pros and cons with each leg of the stool, so to speak, and certainly private equity provides an entrepreneurial model. It provides for both an upfront liquidity event as well as equity and what we call a second bite at the apple when they exit in 3 to 5 years. But there are some cons. Certainly, if they take a majority investment in your practice, they're going to want to run that practice in a certain way, realize those economies of scale, institutionalize back office operations, and in many instances, those back office operations are consolidated. And there is a discipline and a cadence that a lot of independent practices just aren't accustomed and assimilated to, and that's by virtue of the need to realize that exit in 3 to 5 years.
So hospital systems, are there people that are hospital executives in the room? Show of hands. Okay, I think it's safe to say this. Then you all really know this. A lot of the physician groups that we work with, that when they talk about their goals and objectives and the hospital option, a lot of the physician groups we work with say, just take that off the table. Let's not even waste time with that, because hospital executives don't know how to run, manage, or operate physician groups. So I just wanted to point that out. In the middle, payers and strategic players, it's not only Optum and Aetna, and Optum, as you know, is part of United Healthcare. And in some deals, Optum has, especially the multidisciplinary practices, has made very rich offers. But there was an acquisition in the last few months by Mednax, which is also considered a strategic player, national company. You know, others are Envision, Team Health, and the like. And on the right, again, financial sponsors means private equity. And I do want to just say one more thing, I'm sorry, that this isn't really the full spectrum, because there are some groups that decide we're gonna go to a bank and we're gonna borrow money and we're gonna expand on our own. We're gonna open up 5 new organic offices, you know, in these strategic regions over the next several years. We might bring on a couple of smaller groups through having them join our group and purchasing their assets. So obviously that's an option too, as well as merging into a big mega group in your region, like a multi-specialty group where you could be the urology, add to the urology expertise in that group. So I just want to mention that. So.
And really expanding and building on the goals and objectives, we do this in a very, very comprehensive manner. There is no boilerplate cookie cutter approach. Every single organization's goals and objectives are going to be germane and focused on what they're envisioning for their long-term growth, as well as what are the local market dynamics. As we all know, healthcare is very, very local. No matter what practice, what discipline, what geography, it is very nuanced and very different. So we work hand in glove, both from the financial planning as well as the legal and structuring side, to really align, solidify, and flush out fully these goals and objectives. And they're typically, we think about them in 4 buckets: capital and resources for growth, cultural alignment, governance rights and operating model, and monetary value and benefits, right? And it becomes sort of a push and a pull to understand what's most important to the organization that we're working with, and how do we structure the pursuit of a potential partnership or affiliation or transaction in alignment with the goals and objectives. And the goals and objectives, we always say, are like the Constitution. They're not written in stone. They're a living, breathing set of values, and there is flexibility there, but we always contextualize the entirety of the process to ensure that they remain in alignment with the goals and objectives.
Yeah, and capital resources for growth, I think, is very important. I think no matter how great your practice is doing now, I think everybody would agree that there's a lot of uncertainty as to where your practice is going to be, and reimbursement and everything, the local competitive landscape in 3 to 5 years, right? So using bigger is better. I think bigger is better. Data analytics, and EMR are just extremely important, and more capital that could be invested in those things to be more successful in value-based payer contracts with Medicare and others is becoming more and more important. We're just in that kind of beginning to middle of this transformation to value-based payment. So that's really what people are thinking about, is where are we going to be 5 years from now? And on cultural alignment, I think it warrants a little bit further discussion. I've been involved in a number of processes where an advisor comes in and they decide, the group decides based on that advice to let's dip our toe in the water and see what's out there in terms of what proposals, what PE or national strategic companies are willing to make an offer for a partnership with our group. And it's not uncommon that the highest offer is not selected. Sometimes it is, but cultural alignment is really important. If your group looks at these proposals and you might decide to do nothing, forget about it, we don't want to do this. But you might say, you know what, look at these 3 or 4 companies really want us. And then you'll look at the top bidder and maybe the second and third bidder, and you're going to do what we call reverse diligence. You're going to talk to physicians that have partnered with them, maybe in ophthalmology or dermatology, and you're going to make sure you're going to go with a group that already has experience in physician services. And this isn't just their first shot at building a physician services platform. So you're going to look at that, you're going to talk to the other doctors, you're going to make sure there's a good feel in the room with the business executives that you're going to be partnering with. And again, it's not always the highest bidder.
Yeah, if I can expand on that, Gary, we're actually working in the final stages of a transaction where an organization really felt it was important to maintain a significant amount of board representation, to have a lot of input and insight into the long-term strategy of the practice, post-partnership with the private equity firm. And in doing so, in aligning around that goal and objective of maintaining governance rights and the ability to influence the operating model, they ended up taking not the first highest bid, not even the second highest bid. They ended up going with the third highest bid because, again, it was in most alignment. It was the third highest economic offer, but it gave them all the governance rights and the ability to influence the operational strategy, and again, the importance of solidifying around the goals and objectives. If you begin with the end in mind, then you know what you're pursuing when you go out to the market, if you so elect to go out to market.
And the right side of this, I think this slide is really important, as is the next one, which we're going to get to in a minute. But in looking at governance rights and operating model and monetary value, one of the really, and it all goes around goals and objectives, is you have to make sure that whatever you decide to explore and then maybe pursue, if the offers are right, has to work for early career doctors in your group, mid-career, and late career, okay? Those are nice ways of saying young and old, but that's really important. And probably at least 5 times in the last 3 months, I've been brought in by a group that has a committee that's just toying around with what they might want to think about, because everyone's talking and reading about this. And their number one problem is getting, all of these constituencies within the group on board. And so what I think is helpful is to bring in a financial advisor and potentially a healthcare attorney who's been through this and could talk through and answer a lot of the questions, because those younger career doctors are firing the questions at us. Mm-hmm. That's what that atmosphere is like. But we've been very successful if the group thinks it's the right decision for the group. Usually the early younger career doctors come around and they see the benefits. Not always, but usually when they really dig deep into the weeds, they think it makes sense, has been our experience.
Yeah, and from a structural perspective, there are ways to structure the incentive alignment for doctors at every stage of their career to make sure that everyone's incentivized, motivated, and in alignment with the proposed partnership. Now, we've talked a lot about the virtues of private equity, but there's no free lunch, right? There are some notable drawbacks, so we want to sort of expand and discuss those. I alluded to it. There is I'll say it nicely, there's a high degree of discipline from a financial and operational performance perspective that many independent organizations just aren't accustomed to. And it's really, every private equity firm is different culturally, from a mission perspective, from a vision perspective, and from how they interact with you as a physician group day in and day out. But it's sometimes it creates a lot of tension when you have someone working in a high building, managing you from a spreadsheet. And those are sort of the wrong type of private equity partner. You should really feel that this is an organization that understands you, understands your clinical practice, and understands your patient's needs, and is willing and able to provide the capital, infrastructure, and support to enable a combined vision, right, for growth. But there is that increased focus on the bottom line, and that can be grating at times.
But that being said, private equity companies are not going to value your practice in the tens of millions of dollars, or in some cases, 9 figures, over $100 million, if they don't like what they see. Why would they invest all this money and the next day change everything? So our experience has been that with the right diligence by the group on the private equity companies that are making offers, that you could weed that out. They don't want to change anything clinically, okay? And if they're investing tens of millions of dollars in you, they probably really like your management team. Mm-hmm. They probably like a lot about your back office, your kind of corporate infrastructure. That's what they're investing in a platform investment, okay? These add-ons are a little bit different because they already have that corporate infrastructure from the first investment they did, and they see you maybe as a smaller group that could benefit, kind of mutual benefit from that corporate infrastructure.
Mm-hmm. Yeah, and just to round out some of the potential drawbacks, again, this is all malleable, and this is the reason why we advise, run a process, a diversified process. If you're so focused on private equity, so be it. It's not a negative perspective on how you would approach it, but certainly include a diverse array of private equity firms because they're all different. And it's really about finding the partner that's in most alignment with your goals and objectives. But generally speaking, if they buy a majority equity stake in your practice, you're going to have less input on governance, right? Governance will change. The board composition or the governance structure of the practice will change. In many instances, given that urology is a relatively new specialty for private equity, you're not going to have organizations that have 20, 15 years of investment experience and really understand your practice at the CPT code level. Certainly, sometimes there is some reduced flexibility in back office operations, but in many instances, to Gary's point, the private equity firms love your back office operations and actually want to support, grow, and finance that growth to help expand operations. And then really, I would say the most pressing issue is the emphasis on the investment horizon period. 3 to 5 years goes by really, really quickly, and as you could tell in this market today, there's a lot of change. Change is the only constant. So, having a partner organization that's really focused on exiting your practice in 3 to 5 years can create some tensions, but certainly there are structural ways to solve for alignment of goals and objectives over that investment horizon.
But I think, and there's a question about this too, is one of the shorter time horizon on the investment, that's by the investor, okay? That doesn't mean that the group goes away. Could you just explain what kind of the second bite at the apple and how that works when the original investor kind of exits, okay? It doesn't mean the doctors exit in whole, if you could explain that.
Yeah, so typically the shareholder doctors will receive a large liquidity event at the closing of the first transaction. But they'll also typically either want to voluntarily or be required by the private equity firm to roll over equity. And that can vary. Again, we've seen it as little as 5%. We've seen it as high as 30% or 35, 40% even. But that rollover equity is what we allude to when we say the second bite at the apple. Let's say it's 20% of the purchase price is rolled over into equity in the partnership. That means you own 20% of the organization that will ultimately be recapitalized and sold at the end of that 3 to 5 year horizon. And in many instances, what we've seen is the second bite at the apple can be 2 to 3 times larger than the upfront liquidity event that you got at the beginning of the investment period. Now, who are they selling the practice and the larger organization to? Private equity firms work in a very tiered system. So today we're seeing middle market and some instances lower middle market private equity firms investing in these first urology platforms. Their objective and goal is to invest in you, grow you, and 3 to 5 years sell you to what they call the blue chip private equity firms. And you know these names. It's the Carlyle groups of the world. It's the Blackstone groups of the world. The KKRs of the world. These are private equity firms that can invest and deploy billions of dollars. And those would be sort of the intuitive buyers for the next wave. And again, KKR and Carlyle's objective is no different than your first private equity partner. They want to continue to build upon that growth in the same manner by virtue of organic and growth via acquisition.
And they don't buy out all of your stock. They'll buy out part of your stock and want the doctors that are still practicing to roll part of it. Mm-hmm. To continue, so there could be even a third bite at the apple.
Yeah, I mean, we always tell our clients, your assets as a clinical practice are not on your balance sheet. You are the assets. The assets are sitting in this room, the physicians. So the partner, a good partner, is going to want to make sure that you are incentivized, aligned, and that you have that proverbial skin in the game throughout the entirety of every single course of these transactions going forward.
Right. So these are the drawbacks, right? So what I think is important, and what I tell groups all over the country, and I've been on too many planes recently in the last year that I really like to talk about, but I'm out there talking to the groups, and what I say is like, you don't have to do anything. Just like we said, more than half of the groups we work with don't do anything, but you should make that decision with your eyes wide open as to what are our options and what strategically should we be considering to make sure we're positioned well 3 to 5 years from now. I was asked to speak at the MGMA National Conference a month ago in Boston, and in connection about the same topic in general to doctors. And MGMA issued this report right in conjunction with their annual meeting called Winning Strategies from Top Medical Groups. And there's just one thing I'd like to read on this point. So the MGMA board chair wrote a paper, and this is the compelling part of it. You may be confidently leading a practice with healthy margins and happy physicians, but success is no reason for not keeping up with shifts in the industry and having an open mind for the opportunities that exist. I think that kind of sums up the whole concept of why, almost like as leaders of the group, a fiduciary duty to the group and to your other members to at least be exploring, even if you do nothing.
And if I can expand on that, we really work with 2 types of physician groups. Physician groups that have the foresight and approach this from a comprehensive manner to say, look, we're in a position of consummate strength today. We don't have to do anything, but it behooves us to be, have the foresight to understand our goals and objectives, have an organizational proverbial look in the mirror and say, what do we want to be given the local market dynamics? That's sort of the ones we love to work with. The ones that we don't like to work with, but we certainly do, are the ones that are a day late and a dollar short. The wolf's at the door. Their local regional market is consolidating at a rapid pace. There may be a platform investment that they're competing heads up with in their market. And their financial controls, their ability to maintain, retain top-level clinical talent, all the nuances that go into building a really good practice aren't there. So those organizations do go to market, but as you can imagine, they don't command a premium valuation, and the terms and conditions of those deals aren't as advantageous to the physicians.
There was a question about debt in connection with the the PE strategy. Could you talk a little bit about that and how that plays out and impacts the physicians?
Yeah, private equity firms typically deploy what's called a leverage buyout model. And the reason they do this is they want to acquire your practice and they will pay, let's use round numbers. Let's say that they offer you $100 million for your practice. They will finance the transaction with about $75, $80 million of debt, and the remainder will be cash equity that they put into the deal. And the reason they do that is very simple. If you can utilize leverage to acquire something, you have to put in less capital, and then your return is expanded on the sale transaction 3 to 5 years down the road. Now, a lot of this leveraged debt, a lot of these transactions were sort of the genesis of the financial crisis in 2007, 8, and 9. So sort of the lenders, the financial sponsor and private equity community, and the advisors and the attorneys that do this work, they've learned their lesson that you can't over leverage these deals because it creates systematic issues for the market. So the terms and conditions and the ability to lever up, so to speak, has been tamed and is really approaching a much more serviceable, a much more sustainable structure on a macroeconomic level. Now, again, there are nuances with regards to individual private equity firms and their risk aversion or non-risk aversion with regards to how much leverage is appropriate. But again, not to give you the commercial, that's why you have to have really good advisors to say, hey guys, the way they're structuring this, there's a lot of risk here. They are putting very little money up, they're levering you up to the gills, and there's no operational plan to pay off this debt. You're going to be in a lot of trouble in 2 years.
But for the PE companies that do it right,
yes,
without over-levering,
right.
My experience is that the doctors with their rollover equity benefit from that also. Can you explain that versus this debt being a negative?
Yeah, so again, you will own a significant amount of the equity in the new organization. So the same arbitrage that the private equity firm is getting by utilizing as much debt as is feasible for the transaction, you share in that upside potential as well, because you're getting the benefit of that leverage by virtue of your equity position in the new organization.
And then there's a question about, okay, so a smaller middle market PE firm does the investment, acquires, rolls up, and then sells to KKR or wherever. Mm-hmm. The question is, what does KKR then do? Right. And my experience is that some of these national players like Optum and Aetna, are a potential or
a Mednax
or Envision or Team Health, right, are options. Or isn't it also true that they could go to Bain or another big and take an investment? Can you talk about that?
That's right. Yeah, and there is no hard and fast rule on how many bites of the apple you have. It's really germane to the strategy that you come together with and execute with your private equity partner. But typically it happens in 2 tiers, right? The middle market firm will partner with you, grow you, and ultimately you, in partnership with them, sell the organization to a blue chip private equity firm. They will continue to pursue that growth via acquisition strategy and grow you to a position of organizational size where it makes sense for an Optum or a Mednax to say, hey, this is big enough, it's going to be accretive, and it's strategic enough for us to be able to pay a premium for it. And that is typically sort of the end of the road. And
they're public companies.
Yeah, they're public companies. Not to say that at that end of the road, there won't be some equity participation for you as a physician. That has inured. We've seen some of that in other clinical specialties. But typically, once you're at the Optum or the Team Health or the Mednax, you know that that's sort of the end of the road from a transaction perspective. You won't be focusing on who's the next buyer in 3 to 5 years.
Let's try to go through the slides.
Yeah, and I think we've talked a lot about some of these shareholder considerations, but every deal is different. Every organization is different, and there are a lot of parameters and attributes that we've done, we do in a systematic way to make sure that we're understanding what are the key considerations, what are the drivers, right? Business growth, how quickly do you want to grow? Are there targets that are already identified for acquisition post-partnership? Financial stability. How much are they willing to give you up front versus have you roll over? And how much do you want to roll over and how much do you want up front?
So there's a question about have we seen any PE investments that failed? Before Hector answers that, part of the reverse diligence, as I mentioned before, and I've been with groups that have gotten, very reluctantly a one-pager or two-pager in writing about their other investments and their market value over time in other specialties within physician groups. So you're going to be looking at not only their culture and approach, but you're going to be looking at their success in dental, in ophthalmology, in dermatology, and the like. But have you seen that in the physician services space?
I mean, there are, it's really the organizations that don't have that strong track record, right? That don't have, there is, I can't express how important it is to have the peer-to-peer conversation. And sometimes the wrong private equity firms don't like it when we say, hey, we need to set up meetings with the doctors at your ophthalmology investment because they want to have dinner together and really talk about what's life like after the deal. If they're saying no, you can't do that, that's probably the wrong private equity partner. But typically they will allow for that, and they will give you the unadulterated. They'll give you the good, the bad, the ugly, and everything about it.
So the process from the perspective of if you decide that you want to see what options are out there and have an advisor kind of go to the market, it's really approximately a 12-month process, which is illustrated here, but we're running low on time, so I'm just going to move it along a little bit and also to answer some of the questions, some additional questions. I think that this slide is pretty important. I think it's important that if you do decide to do some type of partnership or investment transaction with private equity or strategics and any major national company, they're going to turn you inside out, upside down. They're going to do very deep dive diligence if they're going to be investing tens of millions of dollars or more, hundreds, in your practice. And they're going to look at you, they're going to recast your financial statements in GAAP accrual basis, which I'm sure most of you don't use. Most groups are cash basis. And they're going to audit your billing to make sure you're not very aggressive with your coding and that that you're really conservative and that there's no major problems there. They're going to look at all of your contracts. They're going to want you to be in network and be diversified amongst payers. They're going to look at your leases. They're going to look at your debt. They're really going to look at everything. And the key issue they're looking at is, is this really sustainable? Is what we're seeing as the financial picture of this group sustainable? Or are they overbilling? Or do they have issues? Or do they have a lot of sexual harassment lawsuits by 12 different, former employees? They're going to look at everything in that regard. So in that regard, there was a question about, do we recommend doing a quality of earnings, in preparation for a possible a transaction or exploration of options? And I think the quality of earnings is likely going to be done by the partner that you select. But I do think that it's very important to prepare for the transaction. And whether you do a formal quality of earnings or an informal one, I'll let you talk about that. But there's a lot, even before you go to that 12-month process, I think there's a 6 to 12-month process even before you do that, which is making sure that the group, shows well and to do a self-audit or to bring in a company to audit your billing and collection, and to really do a deep dive. Is everyone documenting what they bill and code and everything like that? That's going to be scrutinized as part of this diligence process.
Yeah, I mean, it's no different than preparing your house for sale, right? You make sure it's got great curb appeal, you trim the hedges and make sure the lawn is beautiful and all the other things that go into making sure that you de-risk your deal on the front end by making sure your house is in order, your financials are clean, and everything is ready for that comprehensive due diligence process.
And they're going to look at any contracts you have with hospitals to make sure they don't violate the Stark or kickback law. They're going to look at your at your ASCs. If you own your own ASC, 100% fine and dandy, that's great. If you're a part owner, if your doctors are part owners, is the ASC structured in compliance with the kickback, safe harbors, coding and billing? And believe it or not, compliance programs. I'm sure most of the groups have compliance programs, but surprisingly, the PE investors are really going to look to make sure that that's a robust, truly implemented compliance program. It's just something that is probably not like you self-audit your billing and all that and documentation, but having a compliance program that's more formal is very important. They like to see that. You know, and again, I spoke about this already. Avoid these issues. Get your house in order, and I usually think this is 6 to 12 months in advance, and it's very important to think about. The last thing you want is to select a partner. You got 5 offers, you do your diligence, you pick one of them, then you enter into what's called a letter of intent, and now you can't talk to anyone else. It's exclusive. That's when they do the deep dive diligence. And if they find lots of things, I mean, you might be down the road and you know, they might be backing away from what they offered.
And it erodes the terms of the deal, right? So using the $100 million purchase price example, let's say you've gone into exclusivity, you've found the private equity firm, and you're moving into closing the transaction. If they uncover a material issue in due diligence, it may result in a dollar for dollar discount to that 100. So now the $100 million is now $75 million, and it's a material change. And or it may result in holdbacks, meaning the $100 million purchase price, 80 of which was supposed to be up front, now it's contingent on a matter being resolved within the first 12 to 24 months. And there's a lot of, and structure is the enemy of all deals, right? Structure and time, right? If the deal is so difficult for you to actually realize the liquidity event, it's probably a bad deal. So really the importance of doing this work up front and working with advisors to get your house in order pays dividends on the back end and the ultimate result of your process.
So just to address some of the questions, it says, one of the questions is, what's the benefit of add-ons to the group? Add-ons are key. In fact, if you're the initial platform investment, they're probably going to rely on a core group of your doctors, the senior committee, financial people in your group, including physicians, to help them assess add-ons. You know, is this a good group? Fly out with us. That happens often if it's a flight versus a drive. But they're going to want your input on add-ons, and add-ons are good. Add-ons grow the value. The bigger the group adds to this, remember, it's one MSO. There's one back office, and by growing other groups, you're getting economies of scale, okay? And that's going to grow the value. The bigger the group through these add-ons, the bigger the multiple in the next deal. Right. But you do get diluted. In the example we spoke about before, if you rolled over 20%, when other groups come on, you know, add-ons, they may get rollover equity. Not small ones, but other larger ones, you know, let's say 10 to 15. If it's a 3 or 4 person group, they might not get rollover equity. They might just come on in. But when groups get rollover equity also, from an add-on perspective, everybody gets diluted equally. The private equity and the initial platform owners.
And I'll give a quick financial example using what I call monkey math. So let's say you have $5 million of free cash flow, or EBITDA, right, which is a term for free cash flow. And they pay 5 times that. So now, 5 times 5, you have a $25 million deal. Over the next 3 to 5 years, they want to grow that pie by virtue of these bolt-on acquisitions. So let's say you're able to get your free cash flow from $5 to $10 million. Now, let's assume no EBITDA multiple expansion on the second bite at the apple. Let's say it's 5 times. Now you've taken a deal that was $25 million, now it's $50 million, right? The same multiple. Typically on the second bite at the apple, you get an expansion of your multiple because you're a bigger organization and you command that much of a premium valuation. But holding the 5 times purchase price constant, that just illustrates the natural rationale for why you want to grow via bolt-on.
And so there's a question about ASCs and to what extent are ASCs or lithotripsy joint ventures important. All of the ancillaries, the more ancillaries, the better in terms of valuing the group. So, if the group owns its own ASC, it's better than just, a bunch of doctors in the group owning collectively 15%. But that's going to play in, and that equity usually plays in that the private equity firm is buying part of that equity. So I would say that the more percentage ownership you have, the more that's going to impact the value and the multiple, and in turn how they value your group. Do you want to talk about interest rates?
Yeah, I will. There's a question as would a PE group do a deal where they didn't maintain a majority equity interest? The private equity industry has become so efficient and so specialized that there are groups and organizations that only do minority deals. They don't want to do majority deals. They don't want to have operational and organizational control. They want to have a minority investment and sort of be a passive investor. And there's a whole cohort. And again, we tailor a process in alignment with your goals and objectives. And if those goals and objectives are getting a minority interest financial and private equity sponsor, then we literally craft a customized target list of all the organizations that invest in healthcare services and do only minority interest deals.
So some of the key transaction issues are purchase price, rollover equity terms, your ongoing employment agreements are very, very important. Those are going to be amended in a go-forward basis, usually for a 5-year period. And then there's important provisions like non-competes and also indemnification. But we're going to get to a few more of these questions because we want to answer them as much as possible. So in terms of expenses of advisors, so I'm going to talk about financial advisors, so I don't put Hector on the spot. So there's a range of options in regard to how financial advisors are engaged. Anywhere from a engagement fee and then a percentage of the overall deal to just an ongoing monthly retainer, which I know that's your firm's model. And there's also a model out there, but there's very few firms that do it, which is 100% contingency. Like we don't get a penny, even for expenses, until a deal closes. So as you could tell, that's a wide variety, and there's different advisors that approach it differently. And some advisors are flexible and can modify how they approach that.
And to give you the plug on ECG, I really, as we work with you to align and assimilate your goals and objectives, we assimilate our fee structure in alignment with those goals and objectives. If you say, Hector, we want you guys out there hungry and incentivized with us to get us the highest possible purchase price, we typically structure our fees to be in alignment with that, and we'll take a percentage of that deal. So we're incentivized to get you the highest price. In many instances, in more than 50% of the physician group mandates that we're actively engaged on, we are not incentivized by the deal. We have a fixed monthly retainer, and what it does is it removes that moral hazard of pushing you into a deal regardless of whether or not we think it's good for you, because we're going to make a lot of money on it. And again, we're flexible. We will sort of run the gamut of structures. But again, it's important to keep in mind how you incentivize your advisor is going to drive how that advisor delivers his or her service to you.
And from a legal fee perspective, I just recommend that you, if your normal attorney group hasn't done dozens of these deals, you should really look to someone, a lawyer that's done a lot of these deals, not just one or two. And in regard to fees, it really depends, unfortunately. For a small add-on group, it could be anywhere from $100,000 to $200,000 in legal fees, because the PE firms are still, they're the ones that drive the diligence and the deep dive and the lengthy documents. You got to use their forms. And so we handhold and walk you through what's customary, what's not, and what needs to be changed to make you and your shareholders comfortable. If it's a platform investment, it could be substantially more. Platform investments, because especially if they involve setting up an MSO, which is the way these transactions work, if you don't already have one, the fees could be at least double or triple that. Again, depending on the PE company. There's a question about typical EBITDA before partner.
Yeah, so most practices, independent practices, don't retain their earnings. They sort of, whatever money's left over in the bank at the end of the year, that's distributed out to the partners, whether that's in the form of a bonus or some other payment. What we do is formulate a pro forma financial projection and historical analysis to demonstrate what your free cash flow would be before those end-of-year distributions, so to speak. And the private equity firms, it took about 5 years for them to sort of catch on to this, but now they very much understand that, okay, that's the pro forma EBITDA that this practice generates before shareholder distributions. And that's the way we position you to the market. And the market's become very efficient that the private equity firms completely understand that.
Their whole approach to this, and it's how you build EBITDA, their approach is your owners, the people who are shareholders or members, are owners of this group, and everything gets distributed to you as employees or members. But what they look at this is that if we were to normalize your salaries of the owners, this is only for the owners, not for the other employees. If we were to normalize, now what does normalize mean? Normalize means what the market is, which could be a flat fee of, I don't know, $300,000 or $400,000. But my experience is that most of the PE firms look at somewhere between 30 to 40% of collections. So it's very much productivity oriented. Mm-hmm. So if you take an average of maybe a third in that range, so if you have doctors who are making $600,000, the normalization, if that's what it is in the market, would be $400,000. It would be a third lower. So they'd be making a third. Well, it depends on their collections. So if they're collecting $1.2 million from their own personal efforts, then they would normalize that to $400,000. And the difference between the $600,000 and the $400,000 for each doctor that's in that category, it would add $200,000 to the EBITDA. And some doctors that make less maybe only add $100,000 or a lower amount to the EBITDA. And then you have this EBITDA and you have multiples, as Hector said, in the high single digits or 10 to 12 also. Yep. For bigger groups.
This is actually a great question. What multiples are we seeing for both platform and then what multiples are we seeing for bolt-ons, right? So for the platform is the value driver or the engine. So for the platform, we're seeing anywhere from 8 times EBITDA all the way up to 12 times EBITDA. So that's a very frothy valuation. For the bolt-ons, these are smaller practices. You're literally bolting them on to the platform. We're seeing today anywhere between 6 times EBITDA and in some instances all the way up to 8 times EBITDA. But again, every situation is different and dynamic. The other question was
tax.
We'll talk about tax.
Okay,
what are the effects of rising interest rates? The effect is really the ability to get leverage on the deal, right? Because the interest rate on the debt becomes higher, right? So the ability to lever up as much becomes somewhat challenging, but still, there's modest inflation in interest rates today, and the market for high yield debt, which is what these firms use, is still very active and very healthy.
So I'm just going to go back. There's a question about tax impact, and we didn't go through this slide 25, but payment of the purchase price, how it's structured, and the tax impact, which is the last sub-bullet under payment of purchase price, is very important. And we get involved very early with tax attorneys speaking to your accountants to understand, things like, are all the doctors have been owners for over a year? Okay, what's the basis of certain assets and things like that. But for the most part, though, if it's selling stock that's been owned for more than a year, it's capital gains. As you know, in light of the tax cuts recently, the difference between capital gains and ordinary income is now lower this year than it was in past years. So there's still a difference. It's not as big, but you do try to structure these to have as much of the purchase price be capital gain at the lower tax rate.
And the other thing that is a virtue of the private equity structure and model is all the interest on that debt that they've levered up with is tax deductible, right? So it's sort of a benefit that you inure as well as a shareholder in the post-acquired entity and organization.
So deals are being done in corporate practice of medicine states, and they're done through an MSO structure. And I mentioned this before, but the way the deals are done is if it's an existing platform, it already has an MSO, and it'll, for an add-on deal, they'll buy your assets and you become, employed by them. But if you're the platform investment and you're not, and you really don't already have like an MSO where your non-clinical staff and your assets are held, we have to create that in connection with these deals. And then there's like a business support administrative services or MSO agreement between the practice, which pays these adjusted salaries, and then for the most part, the rest of that is usually part of the management fee.
But there's tons of, if you literally just Google friendly PC or friendly physician private equity structure, there's a lot of research, and it's actually really easy to follow and understand. By you can Google it, and you get more than you'd ever want over a weekend.
And there's a question about, are we aware of any urology group acquisition that failed?
I would say it's so early for this clinical discipline that there haven't been any major successes. Like there have been some major investments, and there have been some platforms that have been created.
But there has been rumor, whether it's urology or not, and I don't want to get into detail because it's just rumor, that in diligence, some of these deals break apart.
They die.
And they die in diligence when they get into the weeds and look at the billing practices and coding and maybe other employment liabilities, not just one-off, but multiple, sexual harassment allegations from multiple people and things like that. That makes it kind of a little bit tainted or nuclear, and some deals in diligence in general do not go forward after that diligence. So I think we got to most of the questions. Do you have anything else?
No.
So thank you very much. I hope this was helpful and informative.